Welcome back to Investing Talk Podcast.
It's good to be back.
Today we are opening up the dossier on BigBear.ai. And right off the bat, I want to set the stage because this isn't just another generic AI software company.
No, not at all.
We're looking at a very specialized player. They're claiming something called decision dominance, mostly in national security and defense. But looking at the research, there's a serious tension here we need to resolve.
There is. It's the classic investor dilemma.
Exactly. Is this a broken story, with shrinking revenue that's just bleeding out? Or is this a massive turnaround play that's sitting on what you're calling a fortress balance sheet ready to explode?
You can make a compelling case for both sides. You really can.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out. Okay, so let's just address the elephant in the room immediately.
Let's do it.
You can't look at Big Bear without seeing this massive flashing red light. Revenue is down 20% year over year. Why on earth are we even talking about a company that is actively shrinking?
That is the headline number, yes. And look, if you're screening stocks just based on top-line growth, you probably skipped right past this, right?
I would have.
But if you stop there, you miss the actual story. So here is that while the top line is messy, the company has fundamentally transformed its capital structure. They've eliminated $125 million in debt.
Okay.
They're sitting on a massive cash pile, and they're using that stability to fuel the integration of their new acquisition, Ask Sage.
Okay, hold on. They've cleaned up the house, sure. But as an investor, I need to know if the roof is still leaking. We have to see if this defense AI narrative actually holds water against the reality of, one, dilution, which we'll get to, and two, execution risk.
Right.
So let's unpack the fundamentals first.
Let's do it.
Okay, so I'm looking at the Q3 2025 numbers. Revenue came in at $33.1 million. That's down roughly 20% from the prior year.
It is.
Now, to be fair, they did beat analyst expectations slightly. The bar was set pretty low, but the trend line is contracting. It's hard to call this a growth stock when the graph is pointing down.
It is contracting, but you have to contextualize that decline. This is a classic transition phase. Big Bear is actively moving away from legacy contracts.
So old business.
Old business. These were older deals that didn't fit their new high-margin focus, basically low-quality revenue they decided wasn't worth keeping. Plus, they're dealing with the notorious lumpiness of government procurement.
Lumpiness. That's a technical term.
In this sector, absolutely. You don't sign a defense contract every Tuesday. The government pays in big chunks at irregular intervals. It's not a subscription business like Netflix.
Or the money just hits every month.
Exactly. So one quarter might look terrible, and the next looks amazing, just based on when a general signs a piece of paper. But look at the guidance. Management raised their full year 2025 guidance to between $125 and $140 million.
So they see a rebound coming.
They're implying they see the bottom. Yeah.
I see the guidance, but let's talk about the bottom line because there's some serious confusion there. I was reading the report and I saw net income was positive, $2.5 million. On paper, that looks great compared to the loss last year. But when I dig in, the operating loss was negative $21.9 million.
Right.
So they lost almost $22 million actually running the business, but reported a $2.5 million profit. That feels like accounting magic. Where did that come from?
It's not magic, but it is accounting mechanics.
Yes.
That profit came from non-operating items, specifically changes in the fair value of warrants and debt derivatives.
Okay, let's pause. Explain that for everyone listening. What does it actually mean?
Sure. So when a company issues warrants, which are basically options for investors to buy stock later or hold certain debt, those are liabilities on the balance sheet. If the company's stock price goes down, the value of those liabilities also goes down.
Because the warrants are worth less.
Exactly. In accounting terms, that drop in liability shows up as a gain on the income statement. So, ironically, because their stock performed poorly or the debt was restructured, they booked a paper profit.
Okay, so the core business is still burning cash. They didn't make money selling software.
Correct. The core operations are still in the red. But that's where Ask Sage comes in. This is the $250 million acquisition that, changes the entire thesis.
How is this different from me just using ChatGPT?
Huge difference. We're not talking about a chatbot for customer service.
Yeah.
You cannot type classified military logistics data into a public large language model like ChatGPT. It's a massive security breach.
Right.
Ask Sage provides a secure, air-gapped environment where defense agencies can use generative AI with their own sensitive data. This is the growth engine.
Okay, so Ask Sage is the shiny new toy. But you can't buy new toys if you're broke. You mentioned the balance sheet earlier. Is it really that strong?
This is arguably the strongest bull argument for the stock right now. It is a financial fortress. They executed a debt restructuring where $125 million of convertible notes were either redeemed or converted.
So their total debt just plummeted.
It dropped from about $142 million down to just around $17 million. It's a massive deleveraging event.
For those not familiar, deleveraging, that basically means they paid off the credit card, right?
Exactly. They paid off the high-interest credit card that was threatening to eat them alive.
I have to admit, looking at the liquidity, it is impressive. I'm seeing reported cash positions around $456 million.
And some data points suggest total liquidity could be upwards of $715 million. It's a lot of runway.
A huge runway.
And look at the ratios. The quick ratio and the current ratio are both sitting at 3.13.
Translate that for us.
So the current ratio measures your ability to pay your short-term bills. A ratio of 1 means you have just enough cash. A ratio of over 3 means they have 3 times as much cash as they have bills due in the next year.
That's unheard of in small cap tech.
It is. This fortress balance sheet effectively removes the immediate bankruptcy risk. It allows them to absorb that burn rate while they scale up, ask Sage.
So they have the cash to survive, but do they have the moat to thrive? What stops a bigger player, like a Palantir or Microsoft, from just eating their lunch?
Their moat is government-grade credibility. You can't just walk into the Pentagon and install software. Big Bear is already embedded with the U.S. Space Force, Defense Health Intelligence agencies.
The switching costs are high.
Incredibly high. It's sticky.
What about this commercial angle I've seen, the partnership with the Kraft Group and the New England Patriots? It's a flashy headline for sure, but is that just PR fluff?
It's more than fluff, but you're right. It's less than a defense contract in terms of dollars. Think of it as proof of concept. It shows their tech can optimize stadium logistics, not just find submarines. It expands their market.
Got it. All right, let's pivot to the charts. The books are cleaner, but the stock price hasn't exactly been celebrating.
No, it hasn't. The technicals tell a story of a battleground.
The stock's trading roughly around $6. It's sitting below both the 50-day and the 200-day moving averages.
Which usually signals a downtrend.
Right, you're underwater. But I see you have a note here about a capitulation pattern. What are you seeing that the averages aren't showing?
Well, first, the beta is around 3.46.
Which means
It's incredibly volatile.
Yeah.
If the S&P moves 1%, Big Bear tends to move almost 3.5%. But here's the interesting part. On the down days, we're seeing massive volume spikes, sometimes over 115 million shares.
Wow, that's a lot of turnover.
It is. And to me, that volume spike on a down day suggests capitulation. It means the weak hands are selling in a panic. But for every seller, there's a buyer. It suggests a bottom might be forming as stronger hands step in.
Okay, and I'm looking at momentum indicators too. RSI and MACD look pretty oversold.
They do. And the stock recently dipped about 6.6% on downgrade news, but bounced right back in pre-market.
So it's showing some resilience.
Exactly. The stock is coiling just under resistance. It's like a spring being compressed. If it can reclaim that 200-day moving average at 642, that could trigger a significant breakout.
But where is it moving to? The consensus on the street is a firm hold with a $6 price target. That's basically where we are right now.
The consensus is conservative. But look at H.C. Wainwright. They're maintaining a buy with an $8 target. That's about 34% upside from here.
Speaking of sentiment, let's shift gears to the news flow. It feels like for every good headline, there are two bad ones.
It really is a battleground of headlines.
On the bearish side, you've got the Cantor Fitzgerald downgrade citing execution risk, which is fair. And then the lawyers are circling this Pomerantz law firm investigation into potential securities fraud.
Right, but you have to filter the signal from the noise. Lawsuits like that.
Yeah.
They're often called ambulance chasing. When a stock drops, law firms announce these things hoping for a settlement. It's standard procedure.
So you think it's noise?
I do. The bullish news is where the signal is. The Ask Sage acquisition is seen as a game changer. And that debt conversion, it removes the financing overhang that terrified investors.
I was looking at a quantitative sentiment score, and interestingly, it's actually leaning bullish, about a 40% bullish bias.
That's a great point. The algorithms see that a $125 million debt elimination is a more significant event than a routine lawsuit.
What about the insiders, though? I'm seeing the CFO and a director sold shares recently, and insider ownership is super low, like 0.5%. That doesn't scream high conviction.
The insider selling is uninspiring, I'll grant you that. But I spy a massive opportunity in the institutional ownership. It's only around 7.5%.
Wait, isn't low institutional ownership bad? It means the big money isn't interested.
Or, look at it the other way, it represents dry powder,
Broad patter.
potential buying power. If this turnaround works, the big funds have virtually zero exposure right now. If the numbers start to turn, they'll have to chase the stock up to get a position. There's a lot of room for them to buy in.
That's a fair counterpoint. A crowded trade versus an empty room. Okay, but let's play devil's advocate. Let's bridge into the bear case.
Always healthy to look at the risks.
The killer for me is the dilution. There's a shareholder vote to double authorized shares from 500 million to 1 billion. A billion.
And the note conversion added about 38 million shares.
So my slice of the pie is shrinking rapidly.
It is. The share count is going up. But I'd argue this is the cost of survival. They traded dilution for debt elimination. A smaller piece of a solvent, growing company is worth more than a big piece of a bankrupt one.
Sure, but a billion authorized shares, that's a lot of potential printing. It's like inviting more people to dinner without ordering more pizza.
It is. The key is whether they use those shares for accretive M&A, like they did with Ask Sage. If they use stock to buy good companies, it pays off. If they just sell stock to keep the lights on, then yes, it destroys value.
And that brings us to execution risk. Integrating a $250 million acquisition like Ask Sage is hard. Mergers fail all the time.
It's absolutely a bet the company moment. There's no denying it. They're pushing all their chips into the center of the table.
Plus, we're back to that lumpiness issue. Government contracts are slow. If they miss a quarter because some paperwork is delayed, the stock could get crushed.
That's the risk. If revenue doesn't stabilize in that $125 to $140 million range for 2025, the thesis breaks. They have to prove they can execute.
And we can't ignore the legal overhang completely. Even if it's baseless, it creates uncertainty and suppresses the price.
It's a distraction, yes. A short-term headwind.
All right. We've looked at the good, the bad, and the ugly. It's time for the verdict. Let's sum up the investment thesis here.
This is a classic show-me story. It is a high-beta turnaround play. The balance sheet is fixed, over $456 million in cash, minimal debt, and they own a niche in defense AI that's growing.
It's definitely risky. You're buying operating losses and major dilution headwinds, but looking at the price, the downside seems priced in at $6. It feels like the market expects them to fail.
Precisely, which is why I'm assigning a bullish score of 7.2 out of 10.
7.2. Okay, walk me through that.
The justification is the asymmetric upside. You have Wainwright's $8 target, some models projecting over 9. The massive cash position prevents bankruptcy. And Ask Sage is the growth catalyst. It's not a perfect 10 because of the execution risk, but the risk-reward is skewed heavily in favor of the buyer here.
Or what's the time horizon for that?
I think this is a multi-year hold, maybe 2 to 4 years, to let this story play out. Or, if you're a trader, it's a swing trade into the next earnings report to see if that Ask Sage revenue actually hits the books.
So if you can stomach the volatility and the dilution, BigBear.ai offers some asymmetric upside in the defense sector.
Exactly. It's not for the faint of heart, but the pieces are there for a major recovery.
That's the verdict on BigBear.ai. If you enjoyed this breakdown, make sure to subscribe, like, and leave a comment on which stock we should cover next. See you in the next episode.